I'm gonna hop right into it because there's a lot to cover today. And as I said, a lot happened in markets. We're gonna talk today about systemic risk. We're gonna talk about zombies, and we're gonna talk about gamma. So all those things that we'll define for you and will give you a little bit of a better context into what's happening in markets. So just wanna make sure, thumbs up if everybody can see my screen. Yeah.
Yeah, we can see your screen.
We can see it. All right. So market update. What's really been going on? What you're seeing on this chart is the S&P 500 in these yellowish bars and a couple of moving averages that I track. The blue line is the 100-day moving average, which has trended up for the vast majority of the time since 2020. Broke down the market, actually, the price broke down below it at some point in January. And as very common, it went back into the so-called scene of the crime by reaching back to the initial breakdown point, which is very, very common for markets to do that. And now the multi-trillion-dollar question is, where's the market going from here? Are we going back to all-time highs, or is this just a rebound rally in something more prolonged that could end up being a bigger move lower? And that's what we're going to try to answer. So 2022 started pretty poorly at the lows. In fact, it was the worst start to a year, at least since 1928, which is really substantial given that we're not in a recession and there was no real catalyst. And we'll talk about why the market actually decided to do that. In addition, we're seeing a lot of selling. You can see that indicated in volume bars here. In fact, almost as much selling as the initial COVID panic in March 2020 in HYG, which is going to be important for future reference, which HYG is the corporate credit market. So we're going to talk about the corporate credit side, the debt side, and not just the equity side, and how that impacts equities as well.
And Itai, when HYG sells off, that means that that means the yields would go up on their end, correct?
Right. So when you talk about bonds, and we'll talk about that later as well, there's an important relationship, an inverse correlation between the yield and the price, in which the yield goes higher, the price goes lower, and we'll talk about that as well. So generally speaking, a lot of it has to do with the expected Federal Reserve rate hikes that we talked about, but it's important to know, are rate hikes generally bearish, or do they result in negative markets overall? The rate hike cycle itself is not bearish. It actually typically gets bearish after the rate hike cycle stops, because it stops for a reason. And then things have tended to sell off. But with the exception of just one market in 1973, generally rate hikes themselves did not result in negative moves for market. Having put that into context, though, what is interesting is that this rate hike cycle is happening from very elevated price to earnings ratios. So if you're looking at where the Fed generally starts raising rates, markets are priced a lot more reasonably, a lot cheaper than what they are today. So this is the most expensive pricing when a Fed starts a rate increase cycle, with the exception of June 1999.
And this is trailing 12 months, correct? So this is a Shiller view?
Right. This is the trailing 12. It's not the expected earnings, but it's the look back 12-month earnings.
Cool.
So let's talk about periods of time where we've actually seen a divergence between high yield or corporate debt and equity markets, because I think it's really important to understand how that could look like as a leading indicator. So what we have right now is a very strong relationship, and we talked about this many times in the past, between the balance sheet of central banks and where the equity markets have been. So generally speaking, we've seen we're in periods where the balance sheet and the amount of liquidity effectively in the system increases, equities tend to perform well and risk assets in general tend to perform well. And they've been a lot more volatile in periods of time where the balance sheet was not growing. So it's important to keep that relationship in context when we're talking about generally the rate hike cycle or how the Fed can change course. So why is it so important when we're focusing on the high yield credit side? Because as a result of the Fed increasing liquidity and as a result of low interest rates for a long period of time, post the global financial crisis in 2008, we've seen a generally new phenomenon that has entered the market. That new phenomenon is companies that effectively the cost of their earnings are not high enough to service the cost of the debt. So that means that the total amount of debt payment is higher than the profit of that specific company. And now the amount of companies that are, quote, zombies is roughly 20%.
And so why is that so dangerous in an environment where you have rising interest rates?
Because the only way for a zombie company to stay alive is by continuously issuing new debt, refinancing existing debt, potentially selling equities, or growing really quickly and getting to the point where profits actually exceed the debt payment. So if you have a rising interest rate environment, it may make it difficult for these companies to refinance debt or get access to new debt in a way that allows them to not default. So that could also explain our initial question about ARK Invest, because ARK actually has a 50% share of companies that are considered zombies. So the rising interest rate scare could have translated to such a larger sell-off in ARK.
Maybe we can just create our own ETF called Zombie Apocalypse. It could be ZMB, and then we could really just we could hit the entire the Reddit crowd. Really go hard on that one.
So it would be a short exposure to US zombie companies. I like it.
And Zombie Apocalypse, you could call it ZAP.
Exactly. Itai, I got a good question from the audience. Can you share some examples of these companies, and is there a way to quickly identify them?
Yeah, I mean, all you have to do is basically see what companies has no earnings. I don't want to necessarily name names because I don't want to make opinions about companies that may grow or continues their earnings. But generally speaking, it's just companies that their debt service is greater than their current earnings, if they even have earnings in some cases.
And I did just post the holdings for ARK. So probably what you said, about half of those are zombies. So it'd probably give you a sense of the type of companies that make that up.
Yes.
Great. Kim, thank you for the question. And we love that. So keep them all coming.
So let's talk about prior instances of divergence between the high yield credit market and the S&P 500 and how that resolved. So we had one in 2014 where the S&P trended up during this period and the high yield credit started trending down. Coincidentally, it was exactly a similar situation where the Fed came from the period of QE following the global financial crisis and started talking about normalization, started talking about rate hikes, etc. And the high yield started selling off, and eventually the S&P caught into it. In summer of 2015, there was a close to a 20% decline, a lot of volatility, another decline into early 2016. And then what happened here? Well, the Fed effectively walked back their normalization plan and introduced another round of QE. And as a result, all risk assets started booming again. What about 2017 to 2018? Well, the Fed started talking about quantitative tightening. So quantitative tightening is the exact opposite of quantitative easing. So how does that work? So imagine you're the US government and you're issuing bonds, which you're using to fund various things. So the Federal Reserve prints money out of thin air and then uses that money to buy the bonds and gives the government money in exchange, and that results in injecting money into the economy, which is why that's been so supportive of risk assets in general. So when the Fed talked about quantitative tightening, what it does is the exact opposite. It has a bond that it's either maturing or selling, and once that's happened, imagine, Jeremy, if you bought a bond in a year and the bond reaches maturity, what happens?
I get my principal.
You get your principal.
I pay back the principal because I bought.
Well,
or no, I bought it.
If you bought
the
bond, you get your principal back.
That's right. Sorry. Yeah.
So you get all your principal back.
Right.
But if you're the Fed and you're engaging in quantitative tightening, you get the money back, and then you just click a button and that money disappears from circulation. So de facto, you are taking liquidity out of the system by draining money. That's what quantitative tightening or QT is. So in 2018, the Fed was talking about doing a series of quantitative tightening. And again, you had a big divergence between the credit markets and the S&P 500. Here, the S&P was running up because it was expecting the 2017 tax cuts to come into play, and ran all the way through. And that really resulted in the markets converging again. And in December 2018, the S&P dropped around 20%, almost entered a bear market for a day, when the Fed effectively backtracked their QT programs completely and resulted in another large rally for asset prices.
So is that how the Fed reduces its debt load?
Yes, the Fed's balance sheet drops simply by them letting the bonds mature and then destroying the money.
So they take the bonds back and then they just make the money disappear. So it sounds like some of these guys divorces.
That Jay Powell divorce, it's going to be a big one. All right, Itai, next slide.
All right, so here's the classic 2007, 2008, where this is why this is so important. When you have an imploding credit market, it's very difficult for the stock market to maintain its balance, because imagine if you are, let's say, a bank and you're able to borrow money at a specific price. If the default risk for that bank increases, the yield on the debt increases as well. And therefore, Jeremy, what would happen to the price of the equity?
Well, the equity would have to go down, because now there's more risk in the underlying debt there. They're paying more for it. So the equity is going to have to get pummeled as well.
And that's exactly why there's such an important relationship between corporate debt and corporate equities. And this is why it's important to track those two together. And in 2007-8, these large impulses down in the credit market led the equity markets to.
So Itai, is it safe to say that, hey, from your point of view, you try to track this corporate bond price to kind of understand what's going to happen with equities?
Yes, I try to assess the level of systemic risk in the system. Given, is there a tight correlation between them? Is there a divergence? And what I'm seeing right now, which has worried me over the month of January and even into December, is we've seen another divergence that coincidentally started when the Fed was talking about quantitative tightening. It really started in November when the Fed made the pivot saying, well, inflation is not transitory anymore, and we're looking to combat it substantially. And as a result, we've seen the credit markets really decouple from equities over the last month or so in a way that I think needs monitoring. If you're looking here in the Fed projection of rate increases, so this is what the Fed funds futures are now expecting for December of 2022. So that is less than a year from today. And that is substantially more hawkish than anything we've seen recently. So there's over a 60% chance now of being anywhere between 125 to 175 basis points. So reminding you, rate hikes are typically 25 basis points each, and we're roughly at 0. So you're talking about anywhere between 4 and 6 or even 7 rate hikes in a year, which is mind-boggling.
Yeah, this is this is pretty more substantial than what we remember before. I mean, even if you were to go back, a month ago, the targeted rate was somewhere between 100 and 125 basis points.
Right, and it's just shifted to price in 1 or 2 more hikes. So why is this even a bigger problem now? So the two examples that I shared with you before, 2014 and 2018, the inflation rate was under 2%, which is the inflation target for the Fed. So they have no problem backtracking and resuming QE. Inflation was completely under control. But inflation at 7% now is not under control. And there is a lot of pressure on the Fed to maintain their inflation mandate. They have 2 mandates, right? They have inflation and they have employment. And the employment mandate is more or less met right now. We're in full employment. and the inflation is not under control at all. So the Fed would, in my opinion, continue to try to bring inflation back under control. There's also a lot of political pressure to do that. Typically, there's an inverse correlation between the party that's currently in power and the inflationary rate. Knowing that there's elections coming in, I wouldn't be surprised if there is political pressure on the Fed too to get inflation under control, which is just another factor to consider. So this is one of the things too that I monitor that I've noticed that is significant here as well. There is the equity VIX, which is basically a measurement of option pricing and how many puts. Effectively, you can think of it as the cost of protection, the cost of volatility on equities. And there's a very similar version of it that happens in the corporate market, which is priced as high yield CDXs. And we're seeing another big divergence between where equity volatility is being priced and where bond volatility has been priced. And historically, those two are really tightly correlated. So that's
And Itai, what's the takeaway on this slide? Just saying that the credit markets the professionals are saying it's riskier than it normally is.
Yeah, that it's riskier, and a lot of times equities may not. Equities may be pricing in equity volatility should be priced in higher, or bond volatility should be priced lower, right? But generally, it's bond volatility that leads equity volatility most of the time. You can see that on a longer time frame going back into November, and you can really see the size of the divergence right now is substantial.
This looks like a reverse flight to quality.
It looks like what, Rob?
A reverse flight to quality.
Reverse flight to quality.
Which means
right.
What?
Which means usually a flight to quality means people selling stocks and buying bonds. But if the stock volatility is lower than the bonds volatility, it's a reverse flight to quality or a flight to unquality, kind of like visiting Alex Green.
Got it. That makes sense. Itai, do you wanna after this maybe pause and take a few cues?
Sure. So you can see that here too. The fund flows to corporate bonds has been very, very negative to start 2022. And in order for the credit markets to stabilize, we will need this to reverse, and the total amount of selling into corporate will probably need to subside. Okay, I know I said a ton. I will stop for a second.
Cool. This is for the audience that's new. This is your time to shine. If there's any questions, feel free to ask them in chat aloud. We want to make sure that this is a good experience for all of you.
The question I have is, if interest rates are going up, will this slow down stock buybacks because the financing becomes more expensive?
That could totally happen. That's historically what has happened.
Let's say you did have an increase to 1.5 basis points. Do you have any idea how much stock buybacks might go down?
No, not at this time off the top of my head.
Got it. There's also another good question in the chat. I'm going to just read this one out. When you say credit here, are you taking leveraged loans into consideration or just high yield?
High yield.
Got it. And can you also, just for some of the other people who are a little,
can I just ask, have you looked at this with both? Because you would think what's happening here is just people are in high yield are scared rates are going up and they're taking that money and putting it in floating rate stuff. So it would be interesting to see with both of them, right?
Yes. Yes, I think we can take this offline at the end of the call, Mahesh, because that's going to lead to a 20-minute discussion.
Okay.
He will make the time at the end. Itai, can you just go back to that VIX divergence? Can you define what that VIX divergence means again?
Yeah, so the idea is that the credit risk volatility, basically credit risk measured by the option pricing on credit, is very tightly correlated.
The orange line, right?
The orange line is very tightly correlated with the purple line, which is the equity volatility measured by VIX. So I just take attention when credit VIX makes a new high and the equity VIX does not, and actually substantially dropped from its recent high. Just to notice, again, these things will likely converge again at some point.
So they'll converge. Does this say anything about like current value of either investment, or just literally the risk associated with each?
It's the risk associated with it each based on the pricing of options. It has nothing to do with the value. So, you know,
Got it. When there's a higher risk in the orange line, would that signify that, hey, maybe there's more cash flows into equities because they're less risky?
It doesn't necessarily mean equities are less risky. It means that the pricing may be incorrect, right? Because you would think markets are very efficient, but they're not always that efficient.
Okay, so it just really comes down to a measurement of the pricing risk.
That's all it is.
Is there also more option trading on the credit now than normal, like the volume on the options?
I actually would argue that there's more trading in equity options. Equity and the VIX is exploding. We'll talk about it in a bit, but the January expiration was over 3 trillion notion.
Well, what I mean is that there has been an increase in the credit options, not compared to the equity.
Yeah, they've been more heavily traded too. The volumes have been really high over the last couple of weeks, 3 weeks.
Cool. Isai, let's keep it on going, man.
Okay, so let's talk about this move from QE to QT, because that's obviously very, very important to understand how that's going to pan out and how much is actually expected. So we all know correlation is not equal causation, but it's still an interesting relationship to notice that since 2009, post the global financial crisis, there has been a 0.97 correlation between the MSCI World Index of all stocks and the balance sheets of the US, China, Japan, and the Eurozone together. So you can see how markets have risen in tandem with that and have basically gone into periods of volatility and chop when the balance sheets were not growing as quickly, and now is expected to get lower. And how is it expected? Let's talk about the runoff. So today there's roughly $9 trillion in the Federal Reserve balance sheet. And there's two scenarios for runoff. There is the quote active sale, where bonds will actually be sold in the open market. And there's just the runoff, where when bonds hit certain maturities, then the Fed will just let them expire and then destroy the money and take it out of circulation. So the expectation right now from this Goldman research that I saw is that there's going to be roughly a drop between 9 trillion to 6.5 trillion by Q2 2024, and all the way to around 6 trillion by the end of 2024. So we're talking about a $3 trillion decrease in the total balance sheet, which can come off to 60 billion in treasuries and 40 billion in mortgage-backed securities per month. That is very, very substantial. And in this chart, I wouldn't pay too much attention into the blue line. The white line is the overall balance sheet. So in these two different scenarios, either active or non-active runoff, this would have the equivalent of taking out 10% of US GDP. Because right now the balance sheet is a little bit over 35%, and it's expected to come off around 25 to 30%. So it could be anywhere between 5 and 10 points in GDP. So again, the sizing here is very substantial, which indicates that the Fed is taking fighting inflation very seriously.
Those taper tantrums, man, you got to watch when the kids have those, not good stuff.
Looks like an ad for ED.
The tantrum is when they don't want the liquidity to stop and the free money to stop. And when the free money stops, investors are not happy.
That is very true.
Okay, so another way to look at this now, starting in 05, S&P 500 in blue, the balance sheet here in white, and you just see the different periods of returns when things are happening. So QE actively happening in green, QE stopping in red. So I know, for example, it says a 13% return during this period, but really in December at the bottom, the Fed announced the reversal of the course. and then it caused this increase. And I think the main lesson from here is that the markets have tended to be pretty much rising and non-volatile during periods of QE, and they've been a lot harder to trend and trade when QE is not there. And for those that are interested, it's not only the Fed, you have the ECB, you have other central banks, and it looks like the global balance sheet holding will start declining around August of this year. They're still actually rising until August. Even the Fed isn't fully done with taper until March. So we're also seeing more money moving to private markets, almost flooding private markets. There's a lot of dry powder in, for example, private equity. Right now, over $3 trillion as the size of that market continues to grow, potentially impacted by what public markets are going through.
Does that include SPACs? Is that what that partially includes?
No, SPACs that are already public, they're considered public. We have trillions in dry powder in different private markets now, and the private markets have passed roughly the $10 trillion mark. Okay, so this is going to be a little bit of a complex topic. So I'm happy to take it in different ways, but I'm going to stop for some questions, because if you're wondering about some of the reasons for this insane market volatility we've seen in January, this can answer some of your questions. Okay, so we're in a situation where options are moving the entire market. The January option expiration that happened on the 21st of January, and then the market bottom the following week, or at least short-term bottom, was a $3.3 trillion notional expiration. So that is massive, massive, massive. Just think about it. In just one day, $3+ trillion worth of exposure through options has matured. So why is that so important? Because a lot of that has to do with what we call gamma imbalance. And what gamma does, so gamma is a second derivative. You have delta in options. So delta is the idea that, what does a movement, or what the rate of change in the price of a stock, let's say you own an Apple option, would do to the price of your option. Now, gamma simply measures the rate of change of delta. But that's a little bit of an under explanation. So I'll give you an example of how that works in the real world. So let's say Jeremy owns a call option for Apple, and he decides to hold that
to the moon,
and he decides to hold it into the expiration date. And I am the market maker, or what we call dealer, that Jeremy buys that option from. So imagine Apple is trading at $95 and his call option is $100 for $100. So it's the day of expiration. We're trading at 95. How much is that option worth? That option is worth very, very little money, right? It's worth maybe
basically zero. It's out of the money.
But if you're in a very volatile market, what's going to happen is, let's say the stock goes from 95 to 105. Then what happens to your option?
I'm in the money.
You're in the money by $5, right?
Right.
So if I'm the dealer, I always have to be flat on my position, because the fact that it goes up and down shouldn't really matter to me. So what do I do if the stock goes to 105? I have to sell Apple. I have to sell the underlying in order to offset that risk. And I have to sell it to the tune of whatever it is your option's in the money for, to offset those deltas. So I do that. And as I do that, it caused the market to, I basically put selling pressure into the market. And then imagine then it goes back to 95. Then I have to basically take out all these positions that I took in order to hedge it. So the idea here is that it just magnifies moves dramatically when you have a lot of options that are into trillions of dollars, and you have to go through this hedging and removal of hedges consistently if you are a dealer in the market. So in some instances, when dealers are what's called short gamma, it can create a negative feedback loop. So imagine the market declines, there's a lot of options, and people, what do they do when the market declines? They buy put options to protect themselves from further declines. So if they buy the put options, the dealers sold it to them, that puts them with a positive delta because they're short put. So what they're going to do is they're going to sell the index in order to offset that exposure, which would create more liquidation, which would create more down market, which would make people buy more puts. Do you follow what I'm saying? The little circular logic there. So as a result, a lot of this gamma situation can create very substantial market volatility, like what we've seen in January, where markets explode in one way, which all the dealers have to buy positions, sell positions, buy positions, sell positions, which is why when the market is what's called in the negative gamma loop, volatility in both directions is really amplified. And when dealers are, quote, long gamma versus short gamma, then the index tends to be more stable and there's a lot less volatility because it goes in the other side. What it means is that if the market falls, dealers actually buy. If the market rises, dealers sell, and volatility is a lot smoother. So you can see that here. And then I'm going to stop because I know this was really, really complex. What you're seeing in the orange line is where the zero gamma is for the market dealers. And in the red, you can see that when the dealers are, quote, short gamma, markets tend to be very volatile. You can see the size of the moves. Each one of these dots is a daily close. So you can see the distance between the dots is way more when we are in the so-called short gamma regime. And when we are not, the moves are a lot smaller. And a lot of it has to do with the way options trade and the way dealers hedge that risk. I know that was a lot. I'm going to stop for some questions there.
Remind us, when are we short gamma? Like, what the hell does that mean?
It's just an idea where the market makers and dealers are, they need to effectively amplify positions, amplify volatility as the way of their hedges of their book. And when they're long gamma, it kind of works the other way around and volatility gets reduced.
And what does amplify mean in English for everybody that's on?
It exaggerates the move. So a volatile move becomes even more volatile. A downward move becomes further down and more extreme. An upward move also could become more extreme.
Got it.
And when you have $3 trillion of notional exposure, as the options market became so large, all these extra derivatives effectively amplify financial market volatility.
Got it. So the presence of all of this option, all this hedging just leads to a lot of these big moves that we might see in a market. So if you're now in a, are you trying to say that if you're in a world of quantitative tightening and you have a whole bunch of people using options, that you could see a lot more of this like heavy up and down type of movements?
Yes, if you're in a sustained downtrend, options trading becomes pretty heavy, dealers are short gamma, then that could definitely be the case. We've seen a pretty big example of that in January.
Cool. Any other questions from anybody so far? Continue with the course, Professor.
Surprised. Okay, let's talk about rates real quick. I know we talked about it a little bit at the beginning of the call.
Oh,
today,
actually, I have a question. Sorry, I know I'm late with this one, but the reason this lesson, can you help translate just very succinctly, because I'm not sure if it was clear, why is this important to understand? Like, what are the repercussions in terms of the effect on markets right now, and what does that translate into for like the average investor?
Yeah, so the main reasoning here is that in a sustained downtrend, if we get one, with the amount of option exposure that's currently there, the dramatic financial volatility and the dramatic volatility between one day and the next could continue. And if that happens, then it could be a lot more than what historically has been the case, just because there is a huge amount of options there, and options have become more and more popular. And it also is a nice explanation of why we've seen such crazy moves in January. Does that answer your question?
Does, yes, thank you.
Sure. Okay, let's talk about rates. So we've seen a little bit of a comeback as well in the so-called PIG risk. That is Portugal, Italy, Spain, and Greece. And we've seen a lot of those rates increase in recent days, as well as bonds around the world have sold off on top of it.
Wouldn't that be pigs if you're going to include Spain in that one?
It is pigs, yeah, the pig nations, the pigs.
I thought you said pig. Nah, I didn't hear the plural in there.
Okay, so as we know, when rates go up, what happens to price? Price falls. And a lot of what the 60-40 portfolio is built upon is the idea that bonds provide diversification for equity. So if equity falls, typically bonds rise, as Rob mentioned before, this flight to quality. So if you have a portfolio that's comprised of stocks and bonds, you should be okay in the long run. But when bonds were trading in such a low yield, you get to a point where it's very difficult to have the yield go even lower. So when yields go higher from a really low place, it could result in a pretty big drawdown for the bond market. And in that case, when that happens, you basically have nowhere to hide, where stocks and bonds fall at the same time. So even in Japan, which has been in the negative interest rate environment for almost 5 years straight, we're seeing that yields have gone above the zero line. And actually, the Japanese 10-year yield is now at 0.2%, which is the highest it's been since 2016, as we're seeing rates go up around the entire world. Why is it important specifically in Japan? Japan has the highest debt to GDP in the entire world than any other country, as they've been in really low interest rates for a long time.
And just as we remember too, when these sovereign nations have debt that's outstanding, as the interest rates rise, they actually have to pay more in interest payments to service their debt. So it's not like you can just snap your fingers and raise interest rates. There's big implications of doing something like that. Big
implications, as you mentioned well. And the main idea behind this seesaw that you see is that when you have a really long-term maturity in the bond market, that would basically suffer the most in price when yields rise, because you have the most amount of time to wait to get your principal back. And if there's a fresh set of bonds that yield more, the price of an old bond is going to correct to the point where it would be even with the new one. So you will basically just lose money on the price of the bond. So you can see that here in the 10-year treasury. You can see the 10-year treasury going back to 2018, and this is 10-year treasury price. And over here is 10-year treasury yield. And you can see how they're perfectly inversely correlated with one another. So, and as we've seen from 2020 to current, when the 10-year rose by roughly 1% or 100 basis points, the price of the bond fell by a full 10%. So imagine if you had that, again, 60-40 portfolio, that would impact you substantially, because you would lose 10% on the bond portion, besides whatever it is, the equity, which may or may not offset it. So in the event that yields will rise from 2% to 3%, you are expected to lose roughly 10% on a 10-year. If it was a 30-year treasury, that loss could be as high as 30%. That's just the way the bond math works.
Equi, could you go back 2 slides real quick? I know somebody had asked to see this again. So can you just cover again quickly how this works? I know you went into more depth on it in that second slide.
Sure. So interest rates and bonds, the bond price are inversely correlated to one another. When rates fall, the price of the bond increases. And when rates rise, the price of the bond falls. So the longer the maturity of the bond, the more susceptible it is to interest rate risk. Because if you think about it, you have a very long time to wait until the bond hits maturity, and then you get your principal back.
In Equi, can you just explain how a bond works on its most basic level? You can just do it between an example between you and me, and I think it'll make more sense than that.
Yeah. So imagine Jeremy buys a bond from me, and the bond has a 5% coupon and a 1-year maturity. So that means that, let's say $1,000. $1,000. I was about to say $1,000. So $1,000, 5% is $50, right? So in a year passes, I'm going to pay Jeremy $1,050 back. So $50 of interest, and then $1,000 back for his principal. 1 year was the maturity date. Now, 1 year is a very short maturity date, because whatever happens in the world, I know the principal is going to be paid, or Jeremy's going to get it in a year. But let's say we do the exact same thing, but now the loan or the bond is 10 years and it's 5% per year. So I have the option of getting out of it early, but if I get out of it early and let's say interest rates dropped, then I'll be able to potentially to sell my holding in that bond for a higher price if interest rate drop. Why? Because I'm basically selling somebody the right to get 5% a year. So if the prevailing interest rates are in the world are now lower, I can command a higher price for it in order to make sure that whoever's getting into it would get the prevailing interest rates. Was that too complicated, or did that make sense?
I think we've done enough where we can keep going. We'll try to make it shorter in the future, but in general, pretty good.
Bonds are one of the most, understanding bonds and debt is one of the most complicated parts of finance. So that's, keep that in mind. But just to understand, price and interest rates are inversely correlated. And the longer the maturity, the greater the risk. It's very simple because you have a long time until you get your money back, you get your principal back. If you have 1 year until you get your principal back, that's the lowest risk. If you have 30 years, it's a much higher risk. And that just makes intuitive sense. So what we're seeing right now is in 2021, we had $18 trillion of negative debt around the world, in which governments were being paid in order to issue debt, which is absolutely crazy. Now we have $8 trillion of negative bearing debt in the world. So we've seen a $10 trillion reduction in the amount of negative bonds out there in the world. And that is substantial because that's new interest payments that are going to need to be made to investors, central banks, etc. And even in Europe, which is the core of the negative world, we're seeing expectations of rate hikes into December. And with all this, big news about it, the ECB is expected to raise rates to 0 by the end of 2022. So they're going to likely go from negative 50 basis points all the way to 0, back to 0. And why is that? Europe is also experiencing a lot of inflation. There's about a 5% already headline CPI, and they're in a very similar problem to the Fed, which is why they're stopping QE, they're going to taper QE, and they're going to raise rates in a very similar way to what the Fed is doing, maybe a few months in a lag. Okay, so I know we talked a lot about all the systemic risk in the market. There are some positives too that counterbalance a lot of these negatives, and I just wanted to briefly mention them before we wrap up for today and open it up for Q&A. So earnings are still really, really solid. Roughly 56% of S&P companies reported earnings are good. They're not decelerating. Earnings growth still 34%. It's a little bit down from the 42% of last quarter, but it's still really solid and earnings are still strong. And typically prices of the S&P are correlated to earnings. At the same time, US earnings hit record highs and they're 40% over their historical trends. So again, until earnings start decelerating in one way, shape, or form, markets typically don't overcorrect while that's the case. But again, that could always be different this time. The jobs market is really, really hot. So if you're looking at the total amount of job openings and you're looking at the total unemployed people versus job openings, there's simply not enough labor to fill all the jobs openings that are going on right now. And we see this with this indicator, the layoffs and quits, which currently people are feeling confident enough about the economy that quits are about 4x layoffs. So if people weren't so confident about their ability to find a new job, they probably wouldn't have quit. And you can see that in different periods of time, for example, 0809, where layoffs were substantially higher than quits. And we're seeing that in an historical spread.
Itai, are any of the states still giving unemployment benefits at this point?
They are, but that's oh, you mean like the COVID unemployment benefits?
Yeah, because I remember that was one of the things that was impacting people searching for jobs a while back. I was just trying to understand if that's still an issue right now or not really.
I think the majority are already off of that, and we see the unemployment rate has gone back to pre-pandemic levels. But what's interesting is that the participation in the labor force has dropped substantially. So less people have went back into the labor force right now than pre-COVID. But some of us could just be baby boomers that just decided to retire after they got used to not working for a year. That's completely could be the case.
And Itai, another quick question. Is there any type of relationship between cheap debt and earnings if you look historically?
Yes. So you could, stock buybacks could make earnings look better. And there has been a lot of stock buybacks.
So you could basically raise debt to do a stock buyback?
That's typically been what we've seen. We've seen when very cheap debt comes in, there's a lot of cash on corporate balance sheets, and a lot of times they use that to buy their own stock back, which pushes the equity price and improves earnings.
Got it. And do we have any idea of how much QE impacted that in this past decade plus?
It's difficult to estimate, but buybacks have made were huge. We'll talk about that in a second. Actually, it's here. So here is your stock buyback for last year, and it was an all-time high. So if you plot the QE chart with this, you'll probably see some level of correlation, but buybacks were 1.2 trillion last year. And obviously 2020, it was not the case, and buybacks are still really, really strong. So at least for now, that's a big supporting factor for the equity markets. Now, in addition to that, LEIs, the leading economic indicators, the majority of them are still positive, durable good order, the job market. The yield curve is flattening somewhat, but it's not inverted yet. So that's not really a recessionary tail. And the stock market's considered a leading indicator as well, which obviously is corrected, but not enough to indicate a potential recession going on. Typically, when the leading economic indicators are still trending up, markets tend to do well. And I will say that it's very rare to get a bear market outside of a recession. It has happened, but it's rare. But a lot of times, obviously, the market is a leading indicator. So those are some of the positives that are out there that mitigate a lot of the risk. But again, what I mentioned at the beginning of the call, the credit risk, I think it's one of the most significant things that are out there. And I'm very curious to see how that gets resolved. So I know
Itai, one of the questions, I'm going to beat you to it real quick. You know, for the people who are sitting there, have some of the growth stocks that got hit 40 to 80% in the past few months versus the indices that didn't get hit as hard.
Yeah.
What's the prognosis of the macro economy for those holdings?
So what do you mean by the prognosis of the macro economy?
I mean, just imagine you're sitting on like a whole bunch of concentration in Coinbase or something, okay? Or let's just say it's DoorDash or one of these other ones. Are things looking better for you? Are they looking worse? Like, how is this macro economy impacting you?
So historically, when you have higher interest rates and you have this kind of shift, the chase over growth of consistent growth is less. So when companies are not as profitable, you know, generally speaking, in the past, when you go through periods that are more that the interest rates are higher and there's just less money in the system, the money tends to choose value over growth. And in periods where there's a lot of easy money and easing and QE and all those kind of things, money chases growth because you can't really get paid for anywhere else. So I think it's really a factor of what the prevailing interest rates are and why, you know, these things have been hit so hard by what the Fed has said. So it really depends, is it all priced in already at this point or is it not? And, you know, that remains TBD.
We've talked about this in the past. Is it still your opinion that the U.S. economy sucks less than everybody else's economy? In other words, money's going to stay over here, keep being invested over here.
I mean, for the most part, we've actually seen a big rotation this past month to emerging markets somewhat, as they are really cheaply valued right now compared to the US. And they also have a lot less debt, way less debt. So look at, for example, the Brazilian index over the past couple of months, and compare that to the S&P. So we actually have seen a rotation into EMs. With that,
Brazil just went through their like recession for a period of time.
All emerging markets led in this. Emerging markets all have been through, or the majority of them have been in a recession, and they've been hit so hard. The value play there is very significant. So I think some money has been going there in the last month or so. So I've actually seen rotation going there.
Yeah. Hey, what do you feel it's going to take to bring some of that sideline money into play, or does it just not come into play because you have sort of older generation holding on to that wealth, and basically until it gets divvied up amongst other people, does it actually ever come back, or do we just sort of talk about it as this massive treasure chest that is just never going to play out?
Yeah, there's a huge amount of money, and that increased post-COVID. I think it's over 5 trillion now. So I feel like if typically I look at it almost as a put option on equities. If equities get cheap enough, I would imagine a lot of that money will make its way back in. If equities are 20, 25% lower, a lot of that money would likely find its way in. But that's just my opinion, right?
I think one of the charts you showed the rates or sorry, the credit outflows. And I think Rob touched upon this as well, and he touched upon the EM equity inflows. But what is the size of kind of the credit outflows compared to equity inflows and outflows, as you were mentioning some of the relationships between the markets?
Yeah, I don't have that directly in front of me, but believe it or not, I've seen a lot. So in January, we've seen some of the highest record retail inflows into equities, which is interesting. So someone obviously had to be selling in order to offset that. So I wonder,
well, what's your I don't know, kind of back of the napkin opinion on that?
Yeah, so CTAs, hedge funds, have a relatively low position in equities. I think CTAs are really negative, which could be bullish, right? Because if the markets recover, all of them are going to have to chase it up. So that could feed into a positive feedback loop and could be a positioning rally kind of thing. So I think the market is in a real inflection point right now, where if it goes a little bit lower, it could really hurt, and you can easily get a 20-25% move down. But if it doesn't, everybody's going to have to chase it higher, and it will actually go back to all-time highs. That's kind of my opinion.
Hey, Ty, on that, I remember we talked about the convexity curve maybe like a year ago. What does that look like right now?
So you mentioned convexity when it comes down to.
Was it convexity? What was that?
Convexity curve is related to mainly options and the idea that things.
Are you talking about the term structure of the VIX?
No, yeah, maybe it was that. There was I think you were like something. There's a curve, and then you said, look at this as a 60-day pre-leading indicator.
I think it's the term structure of the VIX.
Yeah, it's the VIX. You may be talking about the VIX term structure. So VIX term structure is somewhat flat to a little bit normal right now. It was inverted during the crash. It normalized a little bit as the VIX sold off, and it's normal to flat. So it doesn't indicate too much fear in equities at the moment. So after this rebound over the past week or so, 2 weeks or so, it's reflecting less fear. So I'm of the opinion that the VIX didn't see true panic yet, if this sell-off is going to continue. But again, as Seth asked, it could really, I feel it can really go both ways, because you have the fuel to take it in either direction pretty substantially. So the market is in one of these inflection points.
If most of these stocks though are reporting better than expected earnings and beating estimates, that's just going to continue to keep the market stable and up.
Potentially, but I do think we have the question of I'm wondering is, how much is the market forward pricing all that quantitative tightening? Is it pricing it all now, or are we going to grind up and then kind of hit it when it happens? And that's really, I think, the key question there. And these credit market divergences, if you're looking into, let's say, 2017, 2018, can last a full year. So the fact that you're seeing this kind of divergence does not mean that equities have to sell off and catch up to it right away.
So you type there's a 25% drop, then all this cash comes in and then the market rockets back to all-time highs everybody chases? Is it?
I think again, it's a complicated issue because of the Fed and where inflation is, because we don't know what it's like to not have the Fed supporting risk assets. We completely forgot about it. So anywhere, all these things, I think we have to look at playbooks that are pre-2008, to be honest with you, because if the Fed doesn't support risk assets and just does its own thing, then it's very, very different than what we've seen over the last 14 years. And that's really where I'm at, because if the Fed is not there to support risk assets, then it's really a, you know, what's price discovery and how do things look like and things like that. Because what we've seen now is that, yeah, sentiment gets a little bit too bearish, or indicators get a little oversold, or the market gets to the 200-day moving average, and every time that's been a buying opportunity. And the question is, can that last without QE? And that's really what I'm wondering.